Good morning and welcome to Charting the Markets on Friday, the 9th of June 2023. A rise in US jobless claims led investors to believe that the Fed might pause for longer than was originally anticipated. I mean, already last week we thought and we started to think that basically the Fed next week will not hike its rates in June, but perhaps that might even also be the case in July, and therefore equity markets have risen overnight. And on the back of stronger Asian markets, we had the FTSE 100 trying to recoup some of yesterday's losses because it was trading on ex-dividends. We had lots of dividends out for UK companies, and that pushed the FTSE 100 index slightly lower. So it's a laggard compared to other European and global equity markets, which are all heading higher again. But as we can see here, the FTSE 100 is trading in a very low volatility range and has been doing so for much of this week, except on Tuesday. And from a technical perspective, we're now trading back above the 200-day simple moving average. That's to say the red line here at 7,541, which could indicate that we're back in positive territory. But right now, the FTSE 100 is really between a rock and a hard place on a technical perspective, because basically on the one side, we've got really good resistance going back to the mid-May low and then also the late May highs and the current June highs, all of which come in between 7,655 and 7,679 on this daily financial bet. And this resistance area needs to be taken out for the bulls to be back in control and for us to be heading back up again towards the 7,800 area. As long as that resistance area caps, it's possible that we may well retest the 200-day simple moving average. And if we were to fall through it, we could then head back down again towards the May low. And in that case, we'll probably also head towards the March low around 7,200. So right now, it's really important to watch these the key technical resistance and support levels for the FTSE 100 with regards to the future medium-term trend. And the story is similar with regards to the DAX 40 German contract. Now, as you can see here on the daily financial bet, again, we've been trading in a very low volatility range for much of this week. And so far, we're holding above yesterday's low at 15,886. And as long as we continue to do so, as this is the last reaction low, that is to say, a low on the candle, which is lower than the previous days and the following days, as long as we stay above there, we may have a retest of the late May and current June highs between 16,080 and 16,115. That's the resistance area we need to take out for the DAX 40 to be able to head back up again towards its all-time record high at 16,333 on this daily financial bet. If, however, next week when we have the Federal Reserve and also the European Central Bank with their rate hikes or perhaps not hiking their rates, but with their monetary policy meetings, that could bring a lot of volatility into the market and perhaps push us out of the sideways trading range we've been in this week on a lot of these global equity indices. So from a technical perspective, if we were to fall either today or next week through this week's low from yesterday at 15,886, we would then most likely be heading back down again towards this breach 1 month downtrend line, which now, because of inverse polarity, should act as a support line at 15,730. And then below there, we've got this really, really important key support area going back to May of this year between 15,659 and 15,625. That's the key support area which needs to hold for further upside to be possible from a medium-term perspective for the DAX 40. And ideally for the bulls to be back in control, we would also need a daily chart close above 16,115. With regards to the US markets, the picture is quite similar in that we've been trading sideways for this week in a relatively low volatility band, and we are once again trying to break out to the upside above the 4,299 high made earlier last week, or actually no, made on Monday of this week. And if that were to be taken out, we would be heading back up again towards the August 2022 high at 4,325. And this is key resistance for the S&P 500. And we'll have to see whether if we do manage to get that high, whether we're going to stall in that area or not, because we've got this potential wedge formation. And a wedge when it does break out, and that would mean we would have to fall through yesterday's low at 4,257. If that were to be broken out, we could have a very sharp downtrend, at least short term, take us back to the March to June uptrend line around the 4,175 mark. So that is one to watch, but short term it looks as if we're going to be heading above 4,299 towards 4,325, the August 2022 high. The US dollar has been volatile of late because of the data. There was much data out this week, so we had a little bit of a quieter phase compared to the weeks before. But the fact that the probabilities of a Fed rate hike being seen at the June 14th meeting from the previous weeks of around 36% of market participants expecting no rate hike to be seen, to this now being around 75%. So the probability of a pause being seen in June increasing drastically has led to the US dollar coming off slightly over the last few days. And the inverse of that can be seen on the euro dollar chart, because the euro makes up 57.6% of the US dollar basket. We have the inverse here, and we had a nice rally upwards yesterday on a higher jobless claims, and that led investors to believe that the Fed might actually pause for longer than just in the month of June with regards to future rate hikes. And that has led to, as I said, a short depreciation in the US dollar, and therefore euro dollar heading up above last week's high at 107.79, and that level is being retested at the moment. We haven't seen any follow through yet, but if we were to rise above yesterday's high at 107.87, then the 22nd of May high at 108.31 would be next in sight, and that basically more or less coincides with the April 10th low. So we've got a potential resistance area there. And then above there, we've got the orange line, the 55-day simply moving average at 108.83, which is a potential upside target for euro dollar. So the question now is, are we in a bottoming formation here? And can we resume the previous medium-term uptrend? Or is this just another corrective phase within the downturn we've seen since the beginning of May? Well, in order to answer that question, basically the downtrend would continue if it were to fall through the May low at 106.36. But as long as we stay above there, short-term further upside momentum looks likely for euro dollar. And this is despite the fact that the Eurozone yesterday sank into a technical recession as a revised first quarter GDP number came in at minus 0.1%. And that meant we had a fourth quarter of last year negative GDP reading, only just, but still negative, and then the first quarter of this year being the same. So therefore, technically, the Eurozone is now in a recession. And this has put the euro sterling chart, under pressure. As you can see here, we're heading back down again towards the early June low at 85.68. And below that, we've got some really good support going back to December of last year at 85.48. And basically that with the early September low at 85.67 is offering a really good support area, which is likely to hold in the next few days. So basically we've got 85.68 to 48 as our support zone for euro sterling, which is likely to be tested. And if it does hold, we could then see a bounce back over the next few weeks. If it doesn't hold, we are likely going to continue in this downward trading phase and perhaps retest the psychological 85 level. Moving on to euro yen, this is interesting because obviously next week the European Central Bank is expected to hike its rates again by 25 basis points, and the Bank of Japan is adhering to its ultra loose monetary policy. So therefore this interest rate differential is still pushing the euro yen exchange rate higher. As we can see here, we are now rising again and heading above Monday's high at 150 yen or so, and we are heading towards this 2-month resistance line at around 150 yen and 83 sen. And above there, we've got the late and early May highs between 151 yen 7 and 61 sen. So these are the upside targets. As we can see here, we consolidated for a couple of weeks, but now we seem to be heading back up again. And basically, as long as we stay above 148.60, that is to say 148 yen and 60 sen, on a daily chart closes basis, the uptrend for me remains technically intact. Now, the price of oil is heading for its second consecutive week of losses. And if we look at WTI, we can see here that, yes, short term, we're trying to bounce back again today. But if we look at the weekly chart, we can see that we are likely going to have a second week of losses. But basically, over the last month or so, we've just traded sideways. And you can also see that much better on the daily chart. Lots of sideways trading taking place here. And basically, provided we stay below this key resistance area between the 10th of May and current June highs between $73.82 and $74.70, that key resistance area, as long as that caps, it is likely that we're going to slide back down again towards this support area here around the late May low at around $67.12. But right now, we're just trading sideways once more, even though we are on track to close for the second week in a row lower. The price of gold has been interesting as well. You can see here we've retested our uptrend line, and this goes back to November of last year. And we tested it last week, held there, and once again tested it this week and bounced off it once more. And what we're trying to do at the moment is to basically break through this 2-month downtrend line. And basically, if we were to rise above yesterday's high at $1,970 per troy ounce, then we would be successful in that upward break. And then we could retest not just last week's high at $1,983 per troy ounce, but also the orange line here, the 55-day simple moving average at $1,989. So short term, basically, provided we stay above the late May low at $1,933, further upside should be seen with regards to the price of gold. And talking of upside, what we can also see is the price of cocoa. And New York cocoa is now trading at levels last seen in 2016. It's trading at the moment at $3,160. As you can see here, we accelerated higher. And I have to move out onto a monthly chart to show you how far back we have to go. And we are basically on track to reach the July 2016 high. And then above that, the next upside target is the May 2016 high at $3,233. But what is interesting also is, if you count with me here, it's 1, 2, 3, 4, 5, 6, 7, 8. We are on the 8th consecutive upward month with regards to cocoa prices. And that is a very, very strong uptrend, which is likely to continue in the days and weeks ahead. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.